Hello everyone, my name is Fardeen Samim and today we're going to talk about financial management, the backbone of every successful company. Financial management is the art of effectively and efficiently managing financial resources of a company to meet their objectives. The goal is to maximize shareholders' wealth. In this video, we will have a full picture of how companies control their financial resources to their own benefit and which strategic decisions they make. So whether you're a finance student, professional, or simply interested in this subject, this video is made entirely for you. Okay, so before we start, make sure that you subscribe and hit the bell button so you can never miss out any more interesting videos. So let's get our financial management journey started.
Okay, friends, so let's see what we're going to cover for today. We will start by defining the financial management and its objective, followed by the overview of the investment decision activities. Then we will look for the financing decision activities, which is very important. And then we're going to talk about dividend decisions. And then at last, before finishing off this excellent session, we're going to touch on some of the key areas that finance managers should consider before making the key strategic decisions. Okay, what is financial management? We're going to talk about three main points in here. The first one, definition. Financial management is all about managing the financial resources of an organization in order to achieve financial objectives effectively and efficiently. What are the objectives? Well, the primary objective of financial management is to maximize shareholders' wealth. And additional objectives are maximizing profits, maintaining liquidity, managing risk, and ensuring sustainability of the company. And the third point is the key decisions of financial management. This is the point where we're going to discuss on the next sections as well, but the key decisions are investment decisions, financing decisions, and dividend decisions. Okay, so the first key decision is investment decision. Investment decision simply has two key elements. I'm going to explain the elements and you will get the idea behind the investment decisions. The first one is investment appraisal and other key decisions. Investment appraisal simply means evaluating long-term projects to align with the financial objectives of the organization. So investment appraisal is a critical aspect of financial management that focuses on evaluating potential projects and allocating resources effectively. There are several key techniques used in investment appraisal, so we are going to talk about it later in this video. Another element of investment decision is working capital management, and it means simply ensuring day-to-day operations run smoothly by managing liquidity, debt collections, payables, and etc. We're going to talk about it in detail. Investment decisions. To explain this, I want to give you a practical example. Imagine a scenario where a financial manager is deciding between two investment proposals for a company that manufactures handmade wooden furniture. So the first proposal is investing $500,000 in advanced machinery to increase production capacity by 50%. This investment is expected to result in monthly cost savings of $50,000, and due to increased efficiency, additionally it may lead to higher end customer interest, allowing the company to increase prices by 15% and potentially generate an extra $200,000 per month in revenue. So that's a really good options with this proposal. Now let's see the other proposal. The other proposal is opening a new showroom in a prime location that costs about $150,000. The company expects this showroom to boost sales by 20%. Okay, so that results in a monthly revenue increase of $120,000. So after careful evaluation, what should the financial manager do? Well, the financial manager selects proposal 1 because it offers substantial benefits, including immediate cost savings and increased production capacity. This decision is aligned with the company's financial objectives and the goal of maximizing shareholders' wealth. But how did Mark decided to go with proposal 1? He decided using the investment appraisal techniques. What are those techniques? And I'm here to explain you those techniques in the next slides. Stay with me, friends. Okay, so the investment appraisal techniques. There are many investment appraisal techniques, but I want to separate them into primary and secondary techniques. The way I categorize them is based on its usability, the common use of it throughout the world. Most of the companies, whether they're small, medium or large, they mostly depend on these primary investment appraisal techniques, and some of them I'm going to list them in here. So the first one is net present value, or NPV. NPV is a method used to assess the profitability of an investment by calculating the differences between the present value of cash inflows and outflows over a specific period. So it considers the time value of money, which is very, very critical in financial management, meaning it takes the account that a dollar received in future is worth less than a dollar received today. And I think that's pretty important to know for everyone, even if you're not a finance professional. So if the NPV as a result, if the NPV is positive, then that project indicates that the investment is likely to generate more cash than it costs, and that project is considered financially viable. So if the NPV is negative, then the decision should not be going with that project. Okay, so the next investment appraisal technique is internal rate of return, or IRR. IRR is a metric that measures the potential profitability of an investment by calculating the discount rate at which the net present value of cash flow becomes zero. I know it sounds a bit weird, or if you're not a finance professional, if you have not done these calculations before, you may not understand, but here's a simpler explanation to it. In simple terms, IRR tells you the rate of return the investment is expected to generate for the owners. You're right. So the rate of return that the project will give us should be exceeding than the target that we have set. So if the IRR is higher than the required rate of return or the hurdle rate, then the investment is generally considered worthwhile. Another one is payback period. This is very, very important, and I think it's very simple knowledge. The payback period is a simple method that calculates the time it takes for an investment to generate cash flows equal to the initial investment. In other words, if your investment has been $50,000, how long it takes for you to recover that $50,000? So the answer to this question would be you would select the project which would give you 50,000 return in least amount of time. So it's often used to assess the risk of investment because shorter payback periods imply quicker returns. However, it doesn't account for the time value of money. That is the disadvantage of this method, and it makes it less sophisticated than NPV or IRR. Okay, so the last one, or the last category, the last investment appraisal technique in the primary investment appraisal category is return on capital employed, or ROCE. The performer for this is average profit divided into average investment times 100. So what it shows is that ROCE is the profitability ratio, and that it assesses how efficiently a company is using its capital to generate profits. So a higher ROCE indicates that the company is generating more profits in relation to its invested capital. Okay, so these investment appraisal techniques are valuable tools for businesses and investors to evaluate the financial feasibility and potential returns of their projects. Each technique has their own strengths and weaknesses, of course, so they are often used together to get a comprehensive view of an investment viability. Okay, so in here I want some engagement from the viewers as well. So I want you to know that we can also use these techniques in our personal investment decisions. So let me know in the comments if you have ever used these techniques before when making investment decisions. As I mentioned before, there are also other investment appraisal techniques, and I like to call them secondary investment appraisal techniques because they're not used as often as the primary one. The first one is probability analysis. It's assessing the potential outcomes and their probabilities for each project to make informed decisions under uncertainties. So they make different scenarios for each project cash flows, and based on that they analyze the probability and give a score for each project. Another one is sensitivity analysis. It's examining how changes in key variables impact project outcomes. For example, you could select key variables in the number of inventory, number of sales, number of other assumptions that affects the profitability and the risk of the project. Another investment appraisal technique is lease or buy decisions. These are often used it's when you decide whether to lease or purchase assets based on cost and financial implications. So what you do is when you go out and you try to buy an asset, financial managers need to assess the cost and benefit associated with the buying and leasing that asset. So whichever comes gives us a value that is more aligned with the financial objectives of the organization, we have to make that decision. Sometimes it's beneficial for the company to go with the lease option, and sometimes it's beneficial to go with the buy option. Okay, another technique is asset replacement. So financial managers also evaluate whether to replace existing assets with new ones to improve efficiency and profitability. So it's up to the financial managers to decide whether they should use the existing asset or replace the existing asset, and whether the replacement of that asset will improve the efficiency and profitability of the organization. Next one is capital rationing. The allocation of limited resources among various investment projects to maximize returns. So imagine a situation where you have a limited funding and shareholders or owners has prioritization. So what you do is you have to decide the projects which will give you maximum return based on the limited funds available. Okay, another decision is simulation. It's like using computerized models to simulate various scenarios and their financial implementation for decision making for each investment. So it's pretty different than the others, but it also gives you a view of the projects, whether to go ahead with a project or not. Okay, so these were the other investment appraisal techniques. Let's move on to another section, which is working capital management. What is working capital management and why I have listed it here as part of the investment decision? The reason why I have put it as the element of investment decision is because it's very closely tied to investment decisions. It involves ensuring the availability of sufficient short-term resources to support business activities of our ongoing projects. So it's a direct relation between our investment decisions and working capital management. So working capital is a critical aspect of financial management because it focuses on efficiently managing a company's short-term assets and liabilities in order to ensure smooth day-to-day operations and maintaining sufficient liquidity. Okay, so the main objective of working capital management is ensuring sufficient liquid resources are available and that the business is investing in less liquid assets in order to maximize returns or profitability. We're going to talk more on working capital management, so bear with me. Okay, so what are the key areas that we should focus as a financial managers in order to ensure an effective working capital management system? So the first one is working capital operating cycle. Managing the time it takes to convert current assets into cash and minimizing the cash to cash cycle. So it's very important to manage the convertibility of current assets into cash and to ensure that in the least amount of time we are able to recycle the cash that we have in our business. The second area of concern for working capital management is the working capital policies, and every businesses throughout the world uses different policies based on their industry or based on the market that they are doing business. So it depends on the nature of the business as well. Some of the companies prefer going aggressive or conservative, and some of them appreciate over capitalization in the working capital, or some of them would stick with over trading. So each of these working capital policies has their own implications, and we're not going to talk much detail on it in this video. But for you to understand the area, working capital management is concerned with the policies of the working capital management. So I want to engage you in here. So question for you finance professionals. Let me know which working capital policy is working for your business and why. Let me know in the comment sections. Okay, so going on, another area of concern is working capital ratios. Financial managers has to monitor some of the ratios like current ratio, quick ratio, and other ratios to assess liquidity on the regular basis. These are very, very important ratios, and they used to evaluate the current liquidity position of the business. Okay, moving on, another area of concern is the working capital management itself, the management of inventory section, account receivable and payables, and cash or funding strategies. Okay, so these are the four major areas that financial managers has to be concerned and make effective decisions in order to ensure that sufficient liquid assets are available to support the financial resources required for the ongoing projects. So they have a direct relation with our investment decisions. Okay, now that we know how finance managers make investment decisions, we also need to know how those investments are being funded. For each of those projects, we need money to get started. This is where financing decisions come into play. This is one of the key decisions of every organization, businesses throughout the world. Financing decision is about securing funds to meet working capital needs and investment in non-current assets. So the main source of funds available is retained earnings. But these are very unlikely to be sufficient to finance all of the business needs. So finance manager has to find out another ways to finance the projects that we discussed in the first section of this video. So how they do it? Well, luckily we have some options to find the finance for our projects. There are two ways to finance your projects or business activities. The first one is equity, and the another way is debt financing. In the equity financing, we have options such as return earnings, right issues, new shares issues. And in the debt financings, we have options such as long-term debts and short-term debts. Stay with me as we're going to discuss each of these areas in detail. Okay, so equity financing. What are the ways we can use to finance our investments using equity? The first way is to issue a new share. If your company is publicly trading their shares in the stock market, or if you have potential investors interested in your business, you can offer them shares. So sale of ordinary shares to investors, either through IPO, placing, or an introduction to a stock market. Another way is to issue a rights issue. So it's different than the new issue of shares. Right issue means to offering the existing shareholders the ability to buy new shares using a lower price in proportion to their existing shareholding. So if you're a shareholder of a company and that company announces a right issues, so you have the rights to buy that shares at a lower price compared to the market price. Okay, this is a way to attract the existing shareholders to invest more money in the business so that the finance department can use the finances to finance their projects. I hope it sounded right. Okay, the next one is preference shares. This is a very interesting one. Shares which give right, it's a big right, give right to receive dividends before any dividends can be paid to ordinary shareholders. So owners of the preference shares are different than the ordinary shareholders. It has some attracting benefits. For example, if the company is on the stage of bankruptcy and the first person who has the claim over the asset, or a person who has the claim before the ordinary shareholders, or the preference shareholders, so they have this less risk to lose their money if a company has been in the stage of collapse. Okay, another way is using return earnings, which we discussed. It's not a very viable option, but still we can use it. There are also other ways, such as increasing your working capital efficiency, using stock split options, scrip issues, and some Islamic financing contracts. Okay, so these were some of the most important and key elements of using equity financing. So any businesses in the world, if they are a small, bigger size or medium-sized companies, they use these options to raise finance using equity. Okay, so now let's talk about debt financing. We have two ways to finance our projects using debt financing option. The first way is to use short-term sources of debt financing. I'm going to list them here for you. The first way is overdraft and short-term loans. They are simply a bank agreement to provide financing for immediate needs, with overdrafts covering account deficits and short-term loans for fixed amounts over a specific period. Another option for the short-term sources are trade credit. Businesses can obtain short-term financing by purchasing raw materials on credit. This is typically interest-free. Another option is short-term leasing. Leasing assets on short-term basis through contracts with lessor or lessee. Okay, another one is sale and lease back. Selling assets to raise immediate cash and then leasing them back for continued use. Let me give you an example for it. Suppose you're selling a property to an insurance company for immediate cash and then you rent it back. Isn't it amazing? Debt financing using long-term sources. Number one, bonds or loan notes. These can be redeemable or irredeemable with variations like zero coupon bonds, floating rate loan notes, and tax relief options on loan interests. Another way is venture capital. These are funds provided by venture capital firms or wealthy individuals in exchange for shares in your private companies. They are often realized through stock market listings. Another way is to use long-term loans. You can establish long-term loan agreement with banks or financial institutions with specified fixed amounts and interest rates. Another famous long-term source of debt financing is convertible bonds. Bonds that can offer the holder the right to convert them into ordinary shares at a predetermined rate, price, and times. Alright, so now we know how we can finance our investments. We can either choose from equity financing or debt financing. But the question is, which one should we use? That is why financial management role in here is to also measure or evaluate the cost of financing for each of these options. So whichever finance gives the company a result, a cost that ultimately will generate maximum return, or in other words, maximizes the shareholders' wealth, we will choose that finance. So the cost of financing is identifying and evaluating the most appropriate source of finance to meet organizational financing needs. It's one of the key relationships in financial management, and it talks about risk and return. So we are talking about the risk and return associated with each financing option. Financial management is concerned with calculating cost of individual sources of finances and the average cost of organizational finance. So for each finance, whether it's share issue or rights issue, or in the debt financing, if it's bonds or leasing options, we evaluate the cost of individual sources of those finances, and then we compare it with the rate of return that is given to us by the shareholders. So the first method we use is to evaluate cost of debt. How can we measure cost of debt? I have written the formula in the screen. Another way is to calculate the cost of preference share, what it costs the business to issue a preference share. And then we can also evaluate the cost of equity, such as what methods can we use to evaluate the cost of equity. They are dividend growth model and capital asset pricing model. I'm not going to into detail of these calculations, but I have mentioned the formula on the screen. You can see it. We also have another criteria for measuring. It's called weighted average cost of capital. And all of these formulas represent a measurement of cost of finance. So if we are in a business and we want to raise finance for our projects, we must be able to measure or evaluate the cost of financing so that we can make informed decisions. Okay, that was all about the source of financing or finance decision in financial management. Now we are going to talk about dividend decisions. What is dividend decisions and why it is important? What implication it has over the all organizations, to the shareholders or stakeholders? We're going to talk about it in here. Well, to start from, dividend decisions in financial management are about deciding how much profit a company shares with their shareholders as a dividend and how much they should keep for future plans. It's like deciding how much of your allowance to spend and how much to save for something special. These decisions depend on the company's goals, what is the investor's requirement, what they want, and the financial institutions or the financial situation of the company. It is definitely an important part of keeping everyone happy and the company growing at the same time. So financial managers or the chief financial officers of a company need to decide what appropriate dividend payout ratio should be included in the business. So in order to decide dividend, financial managers or financial management role is to consider some factors while making these decisions. There are definitely a lot of factors, but I'm going to write some of the most important one on the screen in here. I'm going to talk about it so you can get a better understanding of it. Okay, so the first factor that we should consider is there are some theories of dividend policy. So if you are making a dividend policy and you want to continue with that dividend policy, you need to understand what each of those policies mean. Okay, so there are different theories and I want to go one by one. The first one is dividend irrelevancy theory. This theory says that the dividend a company pays out don't really matter to investors. What is more important is the company's ability to make profit and grow. So investors can create their own dividends, let's say by selling some of their shares if they want. Okay, so that's the first assumption and consideration that a financial management can make. Another theory suggests, it's called residual theory. It says that a company should pay dividends from what it's left after it has covered all of their investment needs. So if you have invested in all of your projects, what is left in the business, you can pay out to your shareholders. If there's money left over, it can be given to shareholders as dividend. Another theory of dividend policy says that, and it argues that dividends do matter to some investors actually, and especially those who rely on them for income. So companies should consider their investors' preference when deciding on dividend payments. So these are three views of theories on dividend policy, and whichever policy that a company or financial management makes, they should consider the implication of these theories. And luckily, there are also other ways to satisfy shareholders, and we call them alternative cash dividends. If these theories are not enough for you to make decisions, you can rely on other theories as well. We call them alternative cash dividends. So the first one is share repurchase. So instead of giving cash, a company can buy back its own shares from the market. So this can boost the value of remaining shares and benefit the other investors. And scrip dividends are when shareholders receive more shares instead of cash. It is like getting more pieces of the pie instead of a slice. And then bonus or scrip issue. Companies give shareholders extra shares for free. It is like a bonus gift, making shareholders happy. So you can try these alternative theories as well when making your dividend decisions. However, whatever the decision that financial management make, they have to consider some serious and practical constraints. And they are such as legal restrictions. Laws may limit how much a company can pay in dividend. So in certain jurisdictions, there could be some limitations or specific requirements on how much you can pay out as a dividend. Another practical constraint is the liquidity requirements. Companies need their cash to run their daily business operations. So they must balance dividend payment with their keeping enough cash on hand. Another constraint is the profitability. And companies need to make sure they're making enough profit before sharing it with shareholders. So if your company is not making enough profit, your company's image is going down, and on the other hand you're also giving attractive dividends, so it's actually devaluing your company's market price. Another one is talking about loan agreements. If a company has borrowed money, and loan agreements might limit dividend payments. So if you have financed your investment using a long-term loan from banks or financial institutions, they may have this clause in the agreement that says that you cannot pay out dividends in this period, or they might set a limit for dividend payout ratio just to ensure the liquidity of the business is in safe hand. Another one is inflation and risk. We know the world economy is not very reliable or sustainable all the time. So companies need to consider the impact of rising prices and economic risks when deciding on sharing dividends. Another constraint is equity and debt balance. Balancing how much money comes from shareholders and lenders is crucial. And another constraint can be debt repayments. So it's like before, as I mentioned in the loan agreement as well. If a company has debt coming due soon, it might need to prioritize paying them off. So you cannot pay dividend before paying off your debts if they are very urgent and serious. And then there's a great theory within this constraint of practical constraints. They call them the signaling effect. So what it says is that dividend can send signals to investors about the company's health and future prospects. So it's a theory that says when you pay out dividend ratio, when you pay out dividend to shareholders, it gives a signal to the market, to potential investors. So you have to make a very informed decision. You don't want to make your investors unhappy, or you don't want to lose some potential investors as well. Okay, so let's have another viewer engagement in here. Let me know in the comments which of these factors you believe in making dividend decisions are mostly challenging. So if you're a finance professional and you're working in one of the finance department of a large company, and who has access to these options in decision making, what is the factor that you believe is more challenging in making dividend decisions? Let me know in the comments. Okay, let's move on to the other key considerations of financial management before making the strategic financial management decisions. Okay, everyone, so this is our last slide on the financial management topic. In this slide, I'm going to present to you some of the key areas that financial management should consider while making or before making those strategic financial management decisions like investing, financing, and dividend. These are the alternative considerations as well. You need to consider these options as well. So they are such as financial objectives. Financial managers must align the financial decisions with the organization goals, including earnings, earnings per share, dividend per share, gearing levels, profit retention, operating profitability, and other financial ratios. So these are like a signaling effect of a business in the market. Any decision that you make in relation to the financial resources of the business, these numbers will be impacted. So you need to consider your decisions when you make. You need to consider these ratios as well when you make your decisions. Okay, another one is stakeholders. Well, organizations, large companies or small companies or medium-sized companies, they have stakeholders such as internal connected and external connected shareholders such as employees, directors, shareholders, debtors, creditors, banks, government, regulatory, public. So all of these stakeholder groups, they have their own ideas and perspective about a company. So whatever decision you make, those decisions of financial management indirectly or directly is going to affect the perspective of these stakeholders towards the company. Okay, another one is macro environment for businesses. Okay, so You need to evaluate the impact of economic policies in the country you're operating. Economic policies such as monetary, fiscal, exchange rate, interest rate, etc. So competition, government assistance, green policies, and corporate governance regulation, these are some of the important areas that you should look out for and have a great and whole understanding when you're making the financial management strategic decisions. Next one is financial markets. So understanding financial intermediaries, financial markets, international money and capital markets, interest rates, and money market instruments. They are very, very essential and very crucial place to use when you try to manage the risk, the financial risk associated with the business. So when you're making decisions relating your financial resources, you should have full knowledge and understanding of these financial markets as well, because they're going to somehow affect your investment and financing decisions. Okay, next one we have risk management, and it's very, very important one. I think one of the most important area in this slide is the risk management. So financial management need to address forex risk. Forex means foreign exchange risk, and interest rate risk. So you need to understand and look for the ways to manage the risk of exchange rates being going down and up, interest rates going fluctuating all the time. You need to make sure that you have solid understanding of what implications of in your business decision it has. If the forex risk goes up and down, what effect will your company have in your future cash flows? So managing these risks are called the financial management risk management. You consider capital structure theories to balance equity and debt financing. Another key area is the business valuation. You should be able to determine market capitalization of your company, the asset valuation of your business, income-based valuation, cash flow-based valuation, debt valuation, market efficiency of your business, and share valuation methods. So there are many share valuation methods that you can use, but we don't have enough time in this video to explain it. But let me know in the comment, and if you're interested about each of these areas, I will prepare a separate video on them. That way you can have a very deep dive view of each of these areas. So each area in here that I've mentioned, they are very subjective and they have a lot of topics and related contents to talk about. Okay, everyone, so that was the end of the financial management. I would like to thank everyone for staying up until the end, and I really appreciate if you subscribe and follow my social media channels. I have listed them before. You can see it's LinkedIn, YouTube, and TikTok. I will be posting a lot of information on each of these channels, so make sure you provide your likes, comments, sharing it with your friends, and you're free to give me suggestions, and your comments are really valuable to me. It will really help me to grow my channel and motivate me to post more of knowledge, information, and other relevant videos related to business world. Thank you so much. Have a good day.